Even Warren Buffett, the most disciplined investor alive, has made billion-dollar mistakes. That might sound impossible. This is the man known for patience, value, and consistency. But hidden inside his track record are 5 habits that once left him temporarily broke on paper. The contradiction is real. The same habits that built his empire also held him back when carried too far. What's powerful about these lessons is how universal they are. Buffett's errors expose mindsets that lead everyday investors to lose money without realizing it. Today, we're breaking down the 5 money habits that once cost Buffett billions, so you can avoid repeating them in your portfolio. By the end, you'll see why mastering your psychology is more profitable than chasing returns. Let's start with the first habit that cost Buffett hundreds of millions before it turned into his biggest lesson. Habit 1. The overconfidence trap. After decades of success, Buffett started believing his own legend. In 1993, he bought the Dexter Shoe Company, a small footwear maker already declining against competitors. The problem wasn't just the purchase, it was how he paid for it. Instead of cash, he used Berkshire Hathaway stock. The deal seemed smart at the time, but when Dexter collapsed, Berkshire's shares had skyrocketed, turning what looked like a routine investment into a $3.5 billion loss. The deeper issue wasn't valuation, it was overconfidence. Buffett assumed his past accuracy meant his instincts couldn't be wrong. The company's fading fundamentals were ignored because he trusted his track record more than the data. That's the core risk of overconfidence. It turns discipline into blindness. Retail investors fall for it too, buying can't-miss stocks after long bull runs, forgetting markets always correct. Set firm valuation rules and double-check them when you're feeling certain. That's when mistakes hide best. But while overconfidence can sink fortunes, the next habit destroys opportunity, and it's one Buffett says haunted him for years. Habit 2. The paralysis of inaction. Buffett built his wealth by avoiding what he doesn't understand, calling it his circle of competence. That rule saved him from speculation but also cost him some of history's greatest investments. During the rise of technology in the 1990s and 2000s, Buffett stayed on the sidelines. He saw companies like Google, Amazon, and later Apple change the world, yet he waited, insisting they were too hard to predict. Years later, he admitted missing those early moments was painful. While Berkshire thrived, its relative gains lagged behind the explosive growth of the tech revolution. His caution prevented disaster, but it also locked him out of tremendous upside. The underlying habit was fear disguised as discipline. Staying within your comfort zone feels smart, but over time, it erodes performance. Markets evolve, and refusing to understand new industries doesn't make you safe, it makes you obsolete. Every investor faces this inaction trap. Maybe you've researched a stock for weeks but never bought because it felt too hot. Or you watched cryptocurrency triple while you convinced yourself to wait for a pullback. That hesitation feels rational, until you realize learning by observing doesn't pay you anything. Here's the fix: start small and invest to learn. Buffett eventually adapted. His later stake in Apple showed how curiosity compounds faster than fear. A small, thoughtful position keeps your capital working and your perspective growing. Diversify confidence, not guesses. Refusing all risk is just another way of guaranteeing slower progress. Still, there's a deeper flaw that nearly cost him control of Berkshire itself, and it began with too much buying, not too little. Habit 3. The impulse to overpay for control. Before Berkshire Hathaway became the empire it is now, it was a struggling textile company. Buffett's initial investment wasn't logical, it was emotional. The original management had frustrated him with small, unfair deals, so in the mid-1960s, he decided to buy the whole company out of spite. He thought owning it outright would give him control and eventually prove his judgment right. Instead, he walked straight into a money pit. The textile division was in decline, and no amount of management skill could reverse the industry trend. What followed was a decade-long drag on Berkshire's performance. Valuable capital that could have gone into profitable opportunities was tied up trying to fix a dying business. Buffett later called it one of his worst mistakes, admitting the decision came from pride, not logic. That's the hidden danger when control becomes a goal. It tempts you to overpay for emotional satisfaction. Investors do this every day on a smaller scale, doubling down on failing ventures or stocks just to prove they were right. Emotional conviction is disguised as rational analysis, quietly burning capital for years. The key insight here is simple: great investments don't need you to rescue them. If you catch yourself saying, "Once I step in, I can turn this around," pause. You're probably trying to buy control, not value. Buffett only broke free when he transformed Berkshire from a textile company into an investment holding powerhouse, a complete shift in mindset. He stopped rescuing bad businesses and started buying great ones run by capable managers. That pivot reshaped his fortune. Don't buy to fix. Buy what's already winning. Control is powerful when earned through ownership of quality, not when purchased out of frustration. When pride drives the price, every dollar you spend costs twice, once at purchase and again in lost potential. Habit 4. The loyalty bias. Throughout his career, Buffett has shown deep loyalty to the people and companies he believes in. That loyalty built empires, but it also came close to breaking them. One of the clearest examples came in the early 1990s with Salomon Brothers, a major Wall Street investment bank in which Berkshire held a large stake. When the firm became embroiled in a U.S. Treasury bond scandal, Buffett stepped in to protect both his investment and his reputation. He temporarily took over as interim chairman, defended the company before Congress, and fought to restore trust in its name. The effort nearly destroyed Berkshire's credibility. Not only did investors panic, but the years of rebuilding cost Buffett hundreds of millions in opportunity and value. His attachment to the company, and to the people running it, delayed the hard decisions he normally made with precision. Instead of cutting losses, he tried to save face and friendships. That's the essence of loyalty bias. The stronger your emotional connection, the harder it becomes to see failure objectively. Most investors experience this on a smaller scale, holding a losing stock because it once made you money or because you like the CEO. You tell yourself it'll rebound, meanwhile the numbers say otherwise. Buffett learned that lesson the hard way. True discipline means separating admiration from analysis. You can respect a company without keeping it forever. Buffett eventually tightened his standards, focusing on businesses that performed, not ones that reminded him of past success. For modern investors, this means learning to exit with clarity, not guilt. When friends, founders, or familiar brands start underperforming, loyalty feels noble, but money doesn't reward sentiment. Discipline must outweigh attachments. Even Buffett had to learn that distinction. And finally, the one habit that seems prudent at first glance, but quietly makes even billionaires broke on paper, is his tendency to hold far too much cash. Habit 5. Excessive hoarding of cash. Buffett's legendary patience is both his strength and his Achilles heel. For years, Berkshire Hathaway has held record-breaking piles of cash, often over $100 billion, waiting for what he calls fat pitch opportunities. The logic makes sense: hold cash until true bargains appear. But while waiting for perfect conditions, markets move without you. During long bull markets, this conservatism becomes costly. In the late 2010s, while the S&P 500 surged nearly 80% over several years, Berkshire's idle billions earned next to nothing. Inflation quietly chipped away at that value, while competitors kept their capital compounding in high-quality assets. The lesson is subtle but critical: too much patience turns into passive risk. By doing nothing, you're still making a choice, and often an expensive one. Money left uninvested loses power through opportunity cost. Buffett himself admitted that sitting on enormous cash reserves can feel comfortable, but comfort rarely compounds wealth. For individual investors, the same pattern plays out with savings accounts and overly conservative portfolios. Fear of downturns prevents you from letting your cash work, even though gradual market exposure historically outperforms hiding on the sidelines. The fix isn't reckless spending, it's thoughtful allocation. Keep a portion of your capital always active, even if markets seem uncertain. Start with incremental positions or dollar-cost averaging. Build flexibility into your plan so your money's never asleep. Buffett still keeps large reserves for major deals, but he balances them with ongoing investments that maintain flow. The modern takeaway: strategic deployment beats perfect timing. You can't predict the exact bottom, but you can control movement. Capital sitting still misses compounding windows that never reopen. Perfection sounds like prudence. In reality, it's lost profit disguised as patience. So what do all these habits teach us about risk, wealth, and genuine financial discipline? Conclusion: even the greatest investor alive proves that discipline can turn into weakness when reflection disappears. Buffett's story isn't about failure, it's about evolution. Overconfidence, hesitation, control, loyalty, and excessive caution all cost him billions at different points. Yet each one refined his judgment. That's why he remains the world's most respected investor, not because he avoided mistakes, but because he learned faster than anyone else. True financial mastery isn't avoiding losses, it's adapting your thinking before they multiply. Every investor carries versions of these habits. Maybe you're overconfident with a winning trade, or too scared to enter new markets. Maybe loyalty to a favorite company keeps you anchored to a sinking position, Or perhaps you hoard cash waiting for a better time. Buffett's lessons remind you that awareness creates agility. Audit your habits honestly. Which of these 5 patterns is quietly draining your growth? Adjusting even one could mean decades of difference in returns. If you found this breakdown useful, subscribe for more lessons that turn financial legends' missteps into modern advantages. There's no better way to learn than by examining the mistakes of the master himself.